selling is extremely underrated in India and buying is extremely overrated in India. Our thought process was to cover stocks which no one used to cover, right? And to come out with multi-bagger ideas which no one used to even think or look at them. In India, mid-caps are always under-researched. Large caps are extremely over-researched. Broadly, my sense is that, mid-caps is the sweetest part of the market. That's where the growth is highest. The risk is lowest. As Ramdevji always keeps saying us, right? You should have vision to see, courage to buy, and patience to hold. Whole value and growth debate, right? Which always kind of keeps playing out, right? And I'm a firm believer that there is no such concept. So all our funds today, on an average, would have 35 to 40% of our promoters' money in our fund, right? We have our own skin in the game. Our entire salary, our entire saving goes into our scheme, right? So we take a lot of responsibility because our own money is at stake, investors' money is at stake. You look at the kind of money that everyone is made on concentration. It's not made because there are 400 names, 500 names, 300 names in the portfolio. Something is going up at some point of time. It doesn't work that way. So keep quality in mind and then invest wherever you want to, whether you want to do direct investment or direct through mutual fund, completely your choice. But I would say keep quality in mind, keep valuation in mind, and don't get carried away by momentum. We love to buy when the whole world is selling. We don't like to buy when the whole world is extremely excited about it.
Welcome everyone to another exciting episode of Talks with Daulat, where we aim to deconstruct the seemingly complex world of finance and empower investors to take better and relevant investment decisions. My name is Varun Fatehpuria, and I am the founder and CEO of Daulat Wealth Management. Today, we are pleased to have Niket Shah on our show today. Niket is the fund manager of the Motilal Oswal MidCap and FlexiCap fund. He has over 15 years of experience in equity research and portfolio management. Niket has been associated with the Motilal Oswal Group for over a decade now, having previously worked with its securities division as the head of Midcaps research before finally joining the AMC in 2018. Prior to joining Motilal Oswal, Niket worked with Edelweiss Securities as a research analyst. Niket began his career with the Religare Capital Markets as an associate research analyst in the Midcaps team. He also holds a degree in postgraduate diploma in finance from Wellinger Institute of Management. Niket, it is an absolute pleasure to have you join us today.
Thank you so much, Varun, for inviting me.
We have a lot of questions for you today, some from me, some from our investors and clients, so we cannot really wait to get started. So why don't we quickly just jump in? As we could observe from your career, you have been pretty much a mid-cap lifer, if that was even a word, right? So perhaps for the benefit of our audience, if you could throw some color. Number one, what made you start your career in finance? And number two, what is it that is so exciting about the mid-cap space that you have not been able to leave it over the last 15 years?
Yeah. So thanks, Varun, for having me. I think two, three things, right? One is on why I really like about the whole finance theme as such and what really got me hooked on the equity market. So just to give you a brief background, I started my career in 2008. I'm a Wellinger MBA passed out. And 2008 was not the best year to get out of the college. And so I was the only one who decided not to go for the campus placement. And I started doing cold calling because I was very clear I wanted to do equity research and that too in mid-caps. And why it was mid-cap? Because I generally thought that as a person, I don't like to cover one particular thing for a longer duration of time, right? And there is so many exciting themes which happens on a yearly basis, right? And it is much more exciting job if there is multiple challenges around you, right? Rather than just covering, say, for example, steel sector or say metals or power sector or any other sector for a longer duration of time becomes a little bit of a boredom kind of a thing, right, over a period of time. So I thought I'll cover mid-caps, and I think in India, mid-caps are always under-researched. Large caps are extremely over-researched. So I thought there's a significant amount of opportunity for me to add value wherever I would essentially end up going. So that's broadly the thought process which really brought me to finance. And that's one more reason where I was very clear that mid-caps is where I would essentially like to focus disproportionate amount of my time. And that's how it kind of went through. I started with Religare, went to Edelweiss, and from Edelweiss, I came to Motilal Oswal on the sell side. Even when we were at Motilal Oswal, our thought process was to cover stocks which no one used to cover, right? And to come out with multi-bagger ideas which no one used to even think or look at them at that point of time. So that is what it really gives us a significant kick, right? And that's similar kind of a thing we are following in our mutual fund schemes, right? If you look at most of the stocks that we bought in our portfolios, in the last 2.5 years, virtually no one used to cover it, right? Even still, there's very less coverage on it, right? And they have become 7, 8x, 9x, 10x kind of things. So the idea is to cover stocks which no one was looking at without compromising on our QGLP philosophy, be ahead of the curve, take positions, which might not appear to be great today, but over a period of next 1 or 2 years, it will really pay off, right? So as Ramdevji always keeps saying us, right, you should have vision to see, courage to buy, and patience to hold, right? I think we have these three things which we continue to follow very rigorously, and I think that the outcome in terms of the performance that the fund has delivered is just an outcome of whatever we essentially do. Yeah.
So one of the good points, Niket, that you mentioned is obviously I think large cap as a space is fairly well researched. The scope for alpha generation, I think, as the markets are also maturing, tends to diminish, right? That we have probably seen in the West. Maybe India will follow the lead in the next couple of years. And then naturally, investors typically tend to chase returns in the mid cap and the smaller cap space with the understanding that smaller cap has the highest potential to give returns, right? But if you look at the last 10 to 15 years data, it is actually the mid cap space which has given consistent returns. If you could
Right.
shine some light as to why that is the case. Obviously, small cap comes with its own set of challenges, much higher drawdowns, volatility, but it is not able to pay off from a risk reward point of view compared to mid cap.
So I think two things, right? One is I think mid cap is the sweetest spot of the market, right? Today, if you look at the mid cap part of the market, the average size of the market cap companies, right? Say, as per the AMFI directive, it's 101 to 250 names, which is classified as mid cap. The lowest market cap starts at about 18, 19,000 crores, and the highest one is at 50,000 crores. Now that's the sweetest spot of the entire universe that we have in India today on the listed side, right? Why it is the sweetest spot? Because one is, I think, when you're a 25,000 crore market cap company, two things happen. One is that you've seen multiple cycles and your size is relevantly larger for you to absorb any shock, right, in the economy as and when it happens, right? So the drawdowns are much more lower, right, as compared to small caps. And on the higher side, I think when the economy does very well the way it is happening right now, most of them either will be number one or a number two player in their respective categories. And hence, I think, the size of opportunity remains very, very large for all of them, right? So the base is not as large as the large cap, but it's relatively enough for you to give you a 70-80% kind of a return, even from those levels, right? So a 25,000 crore market cap company, can it become a 50,000 crore market company? The potential answer is yes. But can a 2 lakh crore market company become 4 lakh? The answer is yes, but it will take a lot of much more time than the 25,000 crore kind of a market cap company, right? But at the same time, it's very important to look at the downside risk and the drawdowns that it can offer, right? Which, as compared to small cap, it is much more lower, because assuming it's a 25,000 crore market cap company, say an average PE of about 30 odd kind of a PE, broadly it should be northwards of 700 crore kind of a profit number, right? And if you're a 700 crore profit company, I think hopefully you will have a reasonable balance sheet. You would have seen multiple cycles to come to a 700 crore profit number over a period of time. So broadly, my sense is that mid caps is the sweetest part of the market. That's where the growth is highest, the risk is lowest as compared to a small cap. And that's why, in the last 10 years, mid-cap has been the best performing index as compared to large cap and small caps.
Okay. And talking specifically about the fund that you run, the Motilal Oswal Midcap Fund, right? I think it is fair to say that in the last couple of odd years, it has come on pretty much a lot of the investors' screen, right? And that is also reflective in the AUM that has significantly increased from about 2,500 crores in the last year to about over 5,000 crores today, right?
Right.
Do you think, number one, I think it's a two-part question. Is that really just a reflection of performance? Retail investors typically, tend to follow that lead. And number two, do you think you'll be able to sustain this performance going forward as the fund tends to grow in size? What we like to call is sort of like the size, the enemy of returns.
So I think to answer your question in two parts, I think one is that the reason why the performance has been phenomenal is superior stock selection and superior sector selection, right? So one is that you have two elements to it. One is your stock selection, and then there is allocation, right? Wherever we had the highest conviction, we invested the highest allocation, right? And that really paid off in the last 2-3 year period since I've taken over in July 2020. We continue to think that selling is extremely underrated in India and buying is extremely overrated in India. And hence, for me, what is extremely important is when to sell, right? Second, what is important is when we buy a stock, for us, the downside risk reward ratio has to be much more favorable. You can't buy a stock where you say this can become 2x, but it can go down by 75%. Doesn't work that way, right? We want a stock where the downside risk is say 5 or 10% or at best 15%, but the upside has to be magnificently higher, right? So if that really kicks in, right, then it really becomes a slightly more easy decision to really increase your allocation on the stock. Just to give you an example, like some of our stocks like Tube Investments, Zomato that we got at $55. I think our clear mindset was that the downside risk is extremely lower and the size of opportunity and the upside risk that it had to offer is materially higher. So that really gives us a significant amount of confidence to increase allocation. If we buy a stock where we believe the stock can become, say, 50% higher with a downside potential of 50%, our allocation will always be smaller, right? So that's how broadly we think about allocation, stock ideas, and I think that combination has really benefited. Second important thing is that, see, in India, I am a strong believer that across business cycles, there is no businesses where you can say it is structural in nature. This will grow at 20% for 20 years, right? It doesn't happen that way. So there are cycles to play, and every sector goes through a cycle, and we essentially look at those sectors, very, very closely. Like if you look at most of our investing sectors, have been banking, IT, consumer, auto, cement. We generally avoid metals which are very, very cyclical and less predictable in nature, right? So we don't want volatility on those parts, and we are happy to underperform if those sectors do very well in the near term. So that is the second point. The third important point to highlight is that if you look at the way we buy our stocks, right, we love to buy when the whole world is selling. We don't like to buy when the whole world is extremely excited about a sector, right? So for example, if you look at post-COVID, we went overweight on IT. Then in October 21, we went virtually zero on IT because valuation went to 40, 50 times. Like after the Infosys results a couple of quarters back, when every IT stock was getting hammered, we massively increased our weight on IT, right? Because we could clearly see AI wave going to come the next 1.5 years, right? And we wanted to position ourselves ahead of the curve rather than position ourselves, much later in the curve, right? So I think it's all about, when do you buy, how do you buy, what allocation you do, a combination of that results in such kind of, higher alpha generation that we are able to demonstrate. Now, at the same time, I would also like to highlight that, while we always wanted to give a sustainable outperformance to all our investors, in fact, if you look at most of our times, we reasonably do well in a market which goes up as well as when the market comes down, right? Our fund has done reasonably well on both counts. And it's a conscious strategy that we keep thinking at all points of time that we have to give sustainable outperformance to all our investors. But having said that, there are times where some of our sectors where we don't like to buy as per a philosophy of buying only high quality businesses. We are happy to underperform for one particular year. Like, for example, say PSU banks, if they go up, power stocks, if they go up, if some of the stocks where the balance sheets are extremely fragile, they become, up 70, 80% in a bull market like this. We are very, very happy that we don't own the stocks, and we're very happy to underperform that year, right? Because we've seen time and again that essentially fundamentals do catch up with reality over a lag of, say, 6 to 9 months or closer to a year period, right? And we're very happy that if we have a 3-5 months underperformance because of not owning some of these non-quality stocks, and if these non-quality stocks move up, we're absolutely fine with it. We strongly believe that quality does come back with a vengeance, and as and when it comes back over the longer term, the alpha generation is virtually secure.
So one of the really important things, Niket, that I want to pick up, again, a lot of things to talk about. One of the things that you really mentioned is you guys tend to do well in a bull market, but at the same time have the downside controlled, right?
Right.
When we were evaluating the fund, obviously, I think that is reflective in both the downside capture ratio and also the max drawdown and the recovery period that it takes to sort of achieve the next peak, right? Today, when we go and speak to investors, we try and make them understand that it is more about losing less in the down market than it is about making the most in an up market. What message today, Niket, do you have to investors why controlling downside is equally important rather than just chasing returns in a bull market?
See, I think one thing that we have to keep in mind is that the kind of times that we are seeing right now, right, in terms of small cap and mid cap rally, right, I think clearly fundamentals are ahead of the curve, right? The stock price are ahead of the fundamentals. There's no doubt in my mind. Now it can be in specific sectors, and not on the whole market, that's possible. But at a larger level, we are definitely seeing stocks flying where when we just know on the ground, nothing is changing. In fact, it's getting worse than becoming better, right? But yet, I think, there is a lot of frenzy in the retail HNI community to buy some of those stocks, some of the themes which are now being playing out, right? But historically, we've seen, right, if you get stuck in some of them, right, you only have to book loss, right? If you look at some of the stocks which are rallying today in the power space or in the steel space, one should really look at what are the prices right now. And these prices have come after how many years, right? So वो 7 साल 8 साल पुराना भाव है, वो आज आया है और सब लोग इतना एक्साइटेड हो रहे हैं. बट आप ये चीज समझे कि अगर अगर सही समय में अगर आपने गलती से वो स्टॉक आज भी ले लिया, यहाँ पर फंडामेंटल्स आर नॉट सो ग्रेट, राइट? यू विल एंड अप इन अ सिचुएशन वो भाव, ये आज का भाव फिर 7 साल बाद ही आएगा, right?
Correct.
So you will have a significant amount of opportunity loss. And in the near term, there is so much excitement, right? There's so much excitement to buy these stocks because these stocks go up 10%, 5%, 7% every day with massive volumes, with very low delivery volumes, with very less fund participation and institutional participation. And, there's a new frenzy right now where, one company makes an award announcement, the stock goes up 10%, another award announcement, another 10%, while no one wants to really think and figure out whether that order is going to make money or that order is going to make losses for that company. And what is the price that they have bidded at. So no one wants to do that kind of deep research, but abhi to order aaya hai, to boss ek baar stock chalega. I think these kind of things are extremely dangerous. But obviously it's beneficial in the near term, but in the longer term, this doesn't sustain over the longer term, right? And if you get stuck in any of these themes or any of these stocks at a higher level, make no mistake, there is only one way out, which is to book losses. And these are permanent losses, right? If you buy an ICICI bank at a wrong price, you are reasonably sure that at some point of time it will come back and you will get an exit, right? Because the fundamentals are so good in the business. But I'm not too sure about a lot of the other things which are playing right now in the market, right? So we have been very, very cautious of late. We've seen that our large cap allocation is moving up. Our small cap allocation is reducing. If this continues, maybe we'll go to 0% small cap by the end of December. And we would be very happy to have a slightly more conservative portfolio where our focus is to protect our NAV rather than making absolute return. Because we know that, like, if you look at a mid-cap index of 36, 37% from April till now, this will not continue forever, right? I mean, there's some place where even money gets tired, right? So the only suggestion that I have for investors is that while the party is on, you should make most of it, but be mindful of the fact that fundamentals are ahead of the curve. Be mindful of that fact that if you get stuck, you have to book losses, right? And it's quite frustrating to do that. And people who have seen that cycle in 2004 to 2007 and then onwards till now, and I've seen 2008 cycle, right? How bad it was, right? And people who bought a lot of high quality stocks just never got an exit in the following year, right? And it was extremely tough for everyone, who went through that entire cycle as such, right? So that's broadly what my thought process has always been, that we have to give sustainable returns. Yes, if there is a place where there's a high quality company and you believe that this company will do extremely well, why not go for it, right? There's no doubt about it. We have bought Geo Financial, right? Today there's no business in that company, right? But we believe in the next 5 years there will be massive wealth creation and massive value addition that business will make. So we will take disproportionate calls like that. But at the end of the day, the quality of the business, the quality of the promoter who is standing at that business company. And again, downside risk reward ratio is much more favorable for us. So I think one has to keep these things in mind rather than just getting completely carried away by the current wave that we are seeing right now in equity markets.
So obviously I cannot let you go and sort of like asking that. Obviously, I think mid-cap, small-cap space probably has seen 30 to 40,000 crores of inflows, right? Primarily driven by retail and HNI clients, right?
Right.
Obviously, if you look at your portfolio construction today, you are underweight mid-cap, right? Vis-a-vis the mid-cap 150 index and overweight on large cap and small cap, right? Where are you finding opportunities today, Niket, right? I mean, is that a very, very significant and tactical call that you have taken at a mid-cap level that you will probably stick to safer names in the large cap and slowly, gradually, as you pointed out, reduce your small cap allocation?
Yeah, so I think clearly there's no safety in small caps. That's for sure, right? At this point in time, barring a few small caps here and there, which might be very small in size, we don't see material safety in small caps at this point. Valuations are, and given the way 50, it was simple, right? And the projections are, you can make a projection on an Excel sheet, but to deliver in reality is a very different thing, right? So our view has always been that we love small cap and mid cap space, by the way. We also are extremely greedy. We also want to make more and more returns for our investors. We also want to give them higher returns than any of our peer sets. But at the same time, we also have to keep in mind that if there is irrationality in the market, we have to take a cautious approach at some point of time. And hence, we have taken this approach recently that so mid cap is still at 65%, which is a regulatory requirement for us. And we were very heavily skewed towards a small cap. We have benefited out of this, and now we have decided to move to large cap. So you will see more and more addition of large cap if this party continues the way it is. And I will not be surprised that we will get into a situation where 65% will be mid cap, which is a regulated requirement, 30% will be large cap, and 5% or 4% will be cash. Okay. Right? That's and we'll put 0% small cap. And having said that, I think what we have to also keep in mind that large caps also today are not in a situation that they don't offer you any returns, right? There are certain large caps every year. There is a nifty stock which gives you disproportionate amount of return, right? So it is not that nifty or large cap means there is low return, right? We have to find out those names where there will be higher returns this year in large cap, and we are on it, right? We bought a couple of names like Geo, it's already given us 25% return this year. So we have to keep investing in the right set of names to ensure that there is higher returns. At the end of the day, I have to make higher returns. Whether I make from large cap or mid cap really doesn't matter. But we also have to keep in mind that the downside risk is much lower in large cap from these levels. So I would say large cap is much better position right now as compared to mid caps and small cap.
And while we're talking about the topic of valuation, obviously, I think October 2021, when we pretty much hit the peak Nifty 50, hit 18,000 something, it was trading at a 40-time P, right? Today, yeah. I think obviously we have breached 20,000 level, that psychological mark, but the P has significantly come down at about 21, 22. So obviously, while the valuations look stretched across the mid cap and the small cap space, are you still finding opportunities, number one, in the large cap space? And do you think the valuations are much more in sync with the broader domestic earning growth?
I think so. In the large cap space, there is valuation is still in sync in certain pockets. Like NBFCs, we are seeing some opportunities around. We do see some opportunities around the IT side of the market. Look at Infosys, right? It's not gone anywhere, right? Look at TCS, it's not gone anywhere. So we are seeing some of those, I would say, pockets of where there is some benefits in terms of valuation that we can clearly get even from here on. Having said that, in mid-cap space, it's very tough right now. We're just seeing valuations at a level very tough to justify. And we are reasonably sure that earnings growth is not going to materially change, overnight, right? So I don't know what the street is smoking, but for us, we are very, very focused on on valuations. And while we want to buy quality names, I think one thing is very clear: we are now seeing a lot of opportunity in the large cap side, where at least we're seeing 20% upside possibility. On the mid cap side, we're not seeing a lot of names where we can see 20% kind of a upside. And then if you want to get 20% upside, then you go down the quality curve, right? Where the valuation is so cheap, you say, "Arey yaar, itna sasta hai, to वो 40 time में, ये 20 time में, चलो ये तो 30 time हो ही सकता है." And those kind of narrative is something that we always avoid, right? Those are trap narratives, and we don't want to get into a trap. Like something is at 40 times and something else is at 20 times, so that you start thinking, "अरे ये 20 को 30 कर दो." ऐसे नहीं होता है. It is at 20 times for a reason, right? And maybe that 40 is wrong, right? So that's how broadly we look at it. Yeah.
So one of the things also, Niket, that we observed at a fund level is you typically tend to run it with a growth bias, right? I think that's evidenced, let's say, it's significantly, I think, probably the highest P and highest price to book value of the fund. But obviously the fund has performed well, but typically in a rising interest rate environment, growth tends to take a backseat compared to value, right? How do you reconcile this approach of, growth versus value, or is it more like growth at the reasonable price?
Yeah, so I think I have a slightly different view than consensus here, right? I mean, this whole value and growth debate, right, which always kind of keeps playing out, right? And I'm a firm believer that there is no such concept, right? I mean, I can prove that, but maybe for another day on a detailed discussion. But fundamentally, if you look at, I'll give you an example, simple example. If you look at Castrol, it's a phenomenal company. There's no doubt about it, right? But just doesn't grow, right? Because of a lot of reasons, right? But it doesn't grow, and hence the stock price is static, right? But if you look at something like an Aurobindo Pharma in the past, right? Again, wasn't growing, it was static. But then when it started seeing significant growth in earnings, the stock price started seeing meaningful accretion as well. And there can be multiple such examples. These are just two examples that are coming in the top of my mind right now. But there are multiple such examples where the earnings growth drives the stock price higher. I haven't seen a stock where someone can tell me that, oh, this stock is so cheap, although the profit will remain flat for the next 5 years, and then let the stock price go up by 2x. I haven't seen a lot of cases like that. There can be one or two exceptions, but not a lot of them, right? And in my view, hence we strongly believe that we are clearly chasing earnings growth here. We look at the PAT growth of our portfolio. We want to give you about 25 to 30% earnings growth on the portfolio level. And if we believe, and we strongly believe that if you are able to give this kind of earnings growth on the portfolio, which is 25 to 30%, assuming multiples remaining the same, right, you will see 25 to 30% return in NAV as well, right? Because assuming multiples remaining the same. So if a business goes by 25% every year, you believe stock price will at least give you 25% return, assuming everything remaining the same. That's what we continue to focus on, right? Honestly speaking, if still I had to give an answer between value and growth, yes, we are definitely focused on growth rather than value. We don't think, अरे यार ये plant है कंपनी का, इसका replacement value इतना आता है, आज 1,000 crore है, अगर यही plant बनाने जाओगे तो 2,000 लगेगा, तो market cap double कर दो. We are not in that camp.
Okay. No. So one of the things again that we have observed is you are a pretty high conviction, right? I mean, maybe that's at a personal level, but perhaps maybe from a more of a fund house perspective also, and that is very, very evident in the concentrated portfolio number one that you run, and the very, very high portfolio turnover ratio, right? Where you need to get in and get out at the right time, getting the sectoral calls right.
Right.
Why the rationale for such a strategy? Why do you think having a concentrated portfolio is significantly better than having a diversified portfolio spray around multiple companies?
Yeah, so I think two, three things, right? I think one is that we believe that, for example, you have 150 companies in the portfolio, right? A lot of our peer sets have more than 100 companies in their portfolio, and there are 300 days to work effectively, assuming you take a Saturday, Sunday off, and some few holidays here and there. There are 320 days or 300 days to work, like rounded off. How many days you get to research on a particular name? And this is public money. This is not like my money. Whatever I want to do, I will do it, right? This is public money. We take immense amount of responsibility as a house, and our founders have 40%. So all our funds today, on an average, would have 35 to 40% of our promoters' money in our fund, right? We have our own skin in the game. Our entire salary, entire saving goes into our scheme, right? So we take a lot of responsibility because our own money is at stake, investors' money is at stake. So we take a lot of responsibility to do detailed research and then buy a stock, right? We can go wrong, but we are at least very clear that we do a lot of detailed work before, taking a bet. And we're happy to go wrong, right? If some of our assumptions, if we think this company is going to go at 25%, if it goes at 10%, we go wrong, right? And we take corrective actions on that, right? But at least from a detailed research standpoint, from a process standpoint, that is always followed, right? When you want to buy 100 stocks, effectively you have 3 days to work on a particular company. We somehow take, 1 day to at least get an annual report, right? So I don't know how can you do a work in 3 days on a particular company. So I'm sorry, I really can't think about me doing a work on a company for 3 days and buying a stock next day worth 100 or 200 crore rupees, right? It doesn't work that way, at least in Motilal Oswal. So that's what we broadly believe, that wherever you have detailed work done and your conviction is higher, then you can go and put decent amount of allocation, right? And look at all the global guys, right? All the large global guys like, Buffett's of the world and all of them, right? You look at the kind of money that everyone is made on concentration. It's not made because there are 400 names, 500 names, 300 names in the portfolio. Something is going up at some point of time. It doesn't work that way, right? So you have to be selective. You have to miss something. And hence, we like to play at least on the economic recovery part. We want to ensure that we have all the sectors, which we have covered. We look at, for example, infra. We don't want to play the road stocks, right? Companies who make roads and all of that. Hence, we buy cement, right? Then we have consumer, then your banking, which is obviously a reflection of the country's health and country's growth. And then obviously, on the other side, we do have IT, right? Which is a slightly global play. So we do have that mix. Then we have pharma. So broadly, we're well covered. Only areas where we are not covered is metals or power, for that matter, which is slightly more cyclical in nature, and we are absolutely okay to leave it. There might be smaller allocation in the index itself, and we are very happy to leave it. But we will not chase momentum.
Okay, so enough talk about the fund. I'm sure today our audience would have gotten a very good insight directly hearing from a mid-cap fund manager what's really going on, right? I think sometimes we get so lost in the returns and the frenzy of social media that sometimes it is really difficult to look beyond those clouds. So just zooming out, Niket, and a final piece of question. Obviously, I think the India growth story with all the changes that's happening around us, the narrative around India seems to be extremely positive, right? Partially, it has to do with obviously the on-ground changes, but that is also reflective in an allocation shift that we are seeing in the emerging markets out of China, right? Where do you see our country, both from, let's say, a macro perspective and also a broader financial market perspective in the next 3 to 5 years? And do major events like, elections, would that simply be a bump in the road?
Sure. So I think, yes, I think two things, right? I think one is, let's look at the domestic factors, right? Um, the way I look at this entire, last 9 years of the existing government led by Honorable Prime Minister Modi ji, I think broadly all the agendas on the social side are completely done, and the foundation to accelerate growth in the economy is made, right? So whether you're demonetization, GST, then you have Ram Mandir, all of them, right? All those issues are behind, right? I can't think of any more issues left, right, for this government. And hence, I think that whatever issues are still left, one country, one election, all of them will be done and dusted in this year itself, right? So let's take May of next year as an election year, and assuming 10 years getting over and all of that is done, right? The foreseeable next 5 years, I think the government is only one agenda, which is economy, economy, and economy, right? And I think we are going to see the growth of a lifetime. We are going to see a very stable government in the center. We are going to see massive reforms, and we are going to see unprecedented acceleration of these reforms, right? And we are seeing that, right? I mean, if you ask me personally, if I would have been so confident 2 years back, the answer is no. हम ग्राउंड पे जाते थे, दिखता था कि हाँ ठीक है गवर्नमेंट पॉलिसी नॉट, बट राइट नाउ व्हेन वी मीट पीपल on the ground, corporates, non-corporates, everyone on the ground, we see so much acceleration and urgency on the government side to do it, right? At least in my career of 15 years, I haven't seen, right? Where government guy is saying, "Arey, jaldi karna hai, jaldi karna hai, jaldi karna hai," right? Government guy. So the point is that when the government starts working like a private guy, right, then you can have magic out here, right? And look at the global setup now. Look at US, look at China, look at Europe. They are obviously not firing all cylinders, and there is no expectation of them firing cylinders. In fact, they're slowing down, right? So if someone who has a say $1 trillion globally to invest, you look at China, okay, very tough to invest, slowing down economy. Look at US, look at Europe. And then if you look at the other emerging markets, Indonesia, Thailand, and all of them very, very small, then we only have left with India, right? And hence, I think in the next 5 years, I'm very strong believer that we're going to make money of a lifetime in the next 5 years in the mid-cap space. Yes, after 5 years, I definitely believe there will be a bubble as well, because there will be massive money which is chasing right now, right? At some point of time, there will be roadblocks in between, which might not be domestic roadblocks, it might be global roadblocks. Anything going wrong in US can have impact on us, right? But I think from a domestic standpoint, I haven't seen India being better positioned since 2008, at least since my career started. I haven't seen India being in a better position right now from the government intention standpoint, and the kind of euphoria that I see on the ground, the kind of velocity I see on the ground, I haven't seen I mean, if you look at capital goods, the sector where we went overweight last year, the reason why we went overweight was that environmental clearances were a decade-year high, right? And capacity utilization of a lot of companies were getting to 80, 85%, right? When they start thinking about putting up new capacities, right? So we clearly see, massive amount of, stimulus right now done by the government. And we clearly see the focus of the government for the last 10 years has been economy, but not so much. We believe in the next 5 years, this government will only think about one thing, which is economy, economy, and economy.
Great. Thank you so much, Niket, for leaving us on such a positive note. Any final piece of advice that you today would have to investors getting caught up in the mid cap and the small cap frenzy?
No, so I would only recommend you to that have a much more balanced approach to investing. If you are making money at a massively faster pace, right? You buy a stock at 100, it becomes 500 overnight. right? Just take a little bit of a break and think about it. That does a fundamental really justify, right? And look at the valuations, look at the earning potential, and more importantly, look at the quality of management, right? You can get swayed away by buying a stock which is not fundamentally great in a momentum kind of an environment, but once the market really course corrects at some point of time, some of these stocks won't come back to these prices. So keep quality in mind and then invest wherever you want to, whether you want to do direct investment or direct through mutual fund, completely your choice. But I would say keep quality in mind, keep valuation in mind, and don't get carried away by momentum or few announcements made here and there, and sectors go flying up. It doesn't work that in reality. Right? Think about the business and quality of management much more.
Great. Thank you so much, Niket, and hope our audience today had an enriching and enlightening, insightful discussion out of this. And today, if you liked our video and if you're listening to this podcast, please feel free to subscribe to us and give us a thumbs up. And we'll see you into the next one. Thank you.
Thank you.